Hello traders and welcome back to my YouTube channel, IPDATrader. Now in today's video, we're going to be going over a module, strategy, setup, whatever you really want to call it, that has a very high expectancy. I'm going to give you the exact module, what it is, why it works, how to trade it, how to effectively execute on it, and everything else that you will need in order to execute this strategy to the best of your abilities. This is technically a setup or module that you can use to trade, and you don't need to worry about anything else because it really covers everything that you may need in terms of executing trades, managing the trade, placing an effective stop loss, and effective profit target areas. I've prepared a presentation. We're going to be going over that very in depth. Remember to follow my Twitter. Also, remember that on Tuesday, the 8th of August, which at the time of this recording is tomorrow, live streams are going to begin on YouTube, 8 a.m. Eastern. So feel free to tune in. I will be answering questions, looking for trades, trading the markets, and giving trading information overall. So with that being said, let's jump into today's video, which once again, you're going to need to stay till the very end of, because it's going to cover all the aspects of the module, including trade management, as we said before, and everything else that you may need in order to be an effective trader with this module. So make sure that you stick till the very end of the video. With that being said, let's get started with today's module. Alright everybody, so here we are on the presentation that I've actually assembled for you guys. It's going to cover everything there is to this trade. You will find this trade frequently throughout the weeks as long as you look through enough markets, and it's once again an idea that you can simply trade for the rest of your trading career. You don't need anything else besides this. So this is a concept that I originally discovered studying trader Stanty material. He's a great trader, has been in the business since the year 2000 really. So over 20 years of my career as a trader, and all credit goes to him. I've just simply adapted the setup to my liking and the way that I view the market. So let's dive right into it. First of all, and once again, if this sounds confusing as of now, you don't need to worry, because I've got screenshots and trade ideas and examples so that you understand it a little bit better. So what is the pattern? Let's take a look over here. The pattern is very simple to identify. It is a break above, close below, or break below, close above candle, meaning whenever you have this happening where we break above, and once again I'll show you exactly where and when, and we close below, that is the pattern right there. Okay, and I know it's confusing as of now, but everything is going to get clear for you as we work through the presentation. As of now, just understand that the pattern is simply a break above and close below, or a break below and close above candle. It has to happen at specific areas in the chart for it to be valid. Obviously, we will be covering that in a second as well. I use this pattern to execute on the hourly, but I look for them as well on the daily and weekly to execute on the hourly as well. Once again, as it says over here, on the hourly time frame, although you can experiment with any time frame you would like, it is not constrained to the hourly. You can try to trade this pattern on any time frame that you deem is good for you. I've just used them on the hourly. I look at the daily and weekly to see locations, but the pattern execution is mostly done on the hourly. The color of the candle is irrelevant to the pattern, because one might think that, hey, if it's a break below, let's say a previous area, close above, the candle that closes above has to be green, meaning bullish. No, that's not the case. But once again, it is confusing as of now. Everything is gonna get cleared out for you. So this is an example of how the pattern looks. This right here, actually, on the left-hand side, is a trade that I sent out on the signal service, which once again is currently closed, and it's not gonna open anytime soon. But nonetheless, here you have an example of the pattern. We have a swing low, which once again we're going to be covering very in depth in a second. We have a break below the swing low, and we close above the swing low. At the moment we close above, the pattern has formed. This is a bullish example of the pattern. We break below a major swing low over here, and we close above. That's your bullish example of the pattern. This is a bearish example of the pattern. We have a swing, we break above, close below, the market turns around and moves in the other direction. Now into the key of the pattern. This is where we talk about location, which is the key to making this work. For this pattern to work, it is crucial to understand the concept of location, obviously. You will only look for this pattern at major swings in the market, which is once again very, very important. So you have to be looking for, whenever you open a chart, you have to be looking for the major swings, and you're going to look for this pattern at these areas. As an example, looking at this market, you would be looking for this pattern up there, down here, and up there. You would not be worried about the minor highs and minor lows here, because you're looking for the biggest liquidity pool that you can see on the chart. And the bigger the swing, the more stop losses are going to be resting above or below it. So remember that to make this pattern work, you need to make sure that you're understanding location effectively, and that you know exactly where this pattern needs to present itself in order for you to execute the trade. The swing you will be looking for must have not been tested more than 2 times. Otherwise, the pattern becomes invalid. This is crucial to the effectiveness of the pattern, because traders will try to say to themselves, hey, these are major swings in the market. I'm going to look for the pattern up here. In that case, it would be wrong, because the market has been there 2 times plus. Okay, so it can look as a triple top at the time you're trading the pattern. If it already looks like a triple top, just in the case of this example over here, just like it does here, then you're skipping the pattern. Very important. You're not taking that trade, because the market has been there too many times for you to expect traders to get trapped. So let's print a opposite example here. So let's say the market moves very far away. You have this that you're looking for the pattern for, but once again, you have to count this 1, 2, and 3. We've been to this place more than 2 times. At that point, that becomes invalid. Okay, so even if the market comes down here, you're no longer looking for the pattern to go bullish, even though you will find that it does work, but the effectiveness of the pattern is reduced significantly, and therefore you're no longer interested in trading the area. An example of what would be a valid area that we've been 2 times would be this example over here. At this point, you have 2 major highs at the same region. You can look for the pattern here above the swing, because we've been there 2 times, and as we said before, at most the pattern can look like a triple top in this case. If it has more than 3, so if it were to come up here again, then you're no longer looking for the pattern, because we've been there too many times for it to be effective. So remember, guys, at most it can look like a triple top by the time you're in the trade. So before being in the trade, it can look like a double bottom. More than that, you're skipping the trade, because you will find in the charts that the market tends to revisit certain areas many, many times. And at that point, even if it does and print the pattern and goes up, you're not interested in that trade, because the market once again has been there too many times for you to be interested in it. If the pattern appears anywhere else besides a swing point, you have to pass on the trade. Okay, what I mean by this, even if you see you have maybe a collection of highs here, small ones, maybe here again, and the pattern presents itself up above these highs, you're not looking for the entry there, because the location is not good. I wouldn't really call this a significant swing. More so, I would be looking for the pattern at the edges of the range, which would be here and here, and you're not worried about what's happening here in between. Okay, it's very, very crucial to the overall effectiveness and win rate of the pattern. Example of a great location. Once again, we're looking at a daily chart here, and this looks, by the time you're trading it, as a triple top, which is accepted, right? You have the market visits the area for the first time there, pulls back, creates a swing, moves back, gets close to the area, creates another swing, pulls back. At that point, you're still valid to take this trade above this location. Because once again, it's not yet 3 times that the market has been there. It is 3 times by the time you enter the trade, and that's okay. That's accepted, at least to my liking and trading of this pattern overall. Once again, you have to remember the pattern. It does not matter if this candle, this bullish candle that trades through the swing high, closes bullish or bearish. All that matters to me is that we break above the swing and we close below the swing. And this candle right here does exactly that. Yes, even though it looks very, very bullish, but that's the key. Traders are gonna initiate longs even a single pip above the swing. So what do? By the time the hourly bullish candle here closes, you're entering at market, meaning you click the sell button right there. Okay, and we'll talk about stop loss placement in a second as well, but you need to remember that it does not matter the color of the candle. The candle doesn't need to close bearish for it to be a valid swing liquidity trade. As long as we break above and close below, we are valid for the trade. Very, very important to understand. And you have to also remember the visits of the swing. Remember that it's just 1 and 2, and you're looking for the trade. If it does more than 2 moves away, then you're not interested in the trade. Example of a bad location, which is something that we've covered. This meaning that, hey, you do have somewhat of a high swing there because we pull back here and we move down here, but I wouldn't really call this a standout location for you to want to execute this trade. It's in the middle of nowhere. You do not really have a major swing. These areas here are more likely to work than this one is, even though it works, right? We see the break above, close below, we move down. But remember, you're looking for this pattern at key areas in the market, and that's why you're not gonna find them every single day, and that's why you need to look at many markets so that you're able to see which one is closest to trading into a major swing that I can exploit and take advantage of. So that's an example of a bad location. Now, why does the pattern work? The pattern is indicative of trapped traders. Traders will often buy or sell through key swings in the market with momentum, which is something that I've spoken about numerous times. On top of that, people that had stop losses beyond the swing high low have been stopped out. That clears a lot of orders, which results in a great moment to be looking to do business at. So once again, the reason the pattern works is because retail traders will place their stop losses below and above major swings. They will also look to sell with the momentum through key swings. So as the market is trading below the key swing, traders are going to take short positions. And anyone who has long over here is going to get stopped out as the market trades into the swing low. So basically 2 things are happening. Shorts have been initiated and longs have been stopped out, which is a great, how would I describe it? It's a great idea to be looking to do business at that specific point. So keep that in mind. That's the reason the pattern works. You're not just simply putting 1 and 2 together. You're just understanding overall market behavior and participants' behavior as well. You are essentially trading against those who bought, sold through key swings in momentum, which is the example that I've just illustrated to you guys. Step by step, how to trade it. I know that you guys will want this, so I've prepared it for you. So let's do this in a step-by-step format. Well, number 1, identify a major swing in the market on the weekly, daily, or hourly time frame. Once you've done that, you note that on the charts with a line. At least that's what I like to do. Wait for the market to reach the area and break it. Wait for an hourly candle to close, and if it closes opposite to the swing, execute at market. So basically, the moment we trade above the swing and close below, it can leave a wick, that's enough, and we close below, you are executing your trade right there. Target the next logical level on the time frame the pattern is seen on, which is to say that if you see the major swing on the hourly, you're looking for the next hourly level, which in this case would be these highs here. You would be looking to target there. You place your stop loss above below structure, which is above and below thrusts. So let's say that this is the market structure leading into the swing that you're trading. You're then placing your stop above a thrust candle, which is once again a principle that I've spoken about numerous times. You have multiple videos on that on my channel, but just for those who are new, let's say these are candles here printing up and down, and this happens. This is your level. The candle that closed through the level, which in this case would be this one here, that's where you're placing your stop loss. So basically, wherever the swing forms, let's say it forms here and you enter here, you're placing your stop above a thrust candle for a bearish example. If you do have questions regarding this, you can contact me via Twitter and I'll be happily giving you some examples. But remember that you have to be placing your stops above and below thrust candles that close through levels in order to be safe. You're just not placing your stop loss at the extreme. So let's say this is the swing that you're trading, the market moves up into it, breaks above, close below. You're not placing your stop here, even though it may sound logical, but you're not doing that because the market could very easily move up there again, take your stop, and then move lower. You're securing your stop loss with structure on the left. So in this case, over here. Hopefully that makes a little bit more sense to you. What else? Where do we go? Target the next logical level, place your stop loss, and let the trade play out. Live markets that I'm looking for this pattern to form. So these are, as of today, ideas that I'm looking to take this trade on. First of all, we have NZD/USD. I'm looking for this pattern to unfold here. We've been there one time, as you can see. And the moment we break below, close above, I will be looking for a long. Obviously, if you can have ATR confluence, which is a topic for a different day, then that would be ideal, although it's not necessary, and that's why I'm not including it here. This is GJ. We have one where I'm looking for the pattern. And number two, this is also where I'm looking for the pattern to form, which is to say the major swings in the market. You can see we've moved into the area significantly. The level has reacted significantly lower as well. And same for this one. We moved into it aggressively. We react aggressively. This is a big swing in the market. And in this case, you're looking at the daily time frame. So if I were to get long there, I would get long somewhere over here as we close above. And I would target the next logical level, which in my opinion would be here. Now you may look at that and say, hey, that's not really enough range, is it? Well, it probably is, because you have to remember that you're executing on an hourly time frame, and this swing is appearing on a daily. So from here to here, you probably have more than 100 pips that you can capture. So do not get fooled by the fact that this is a daily chart and the ranges look small, okay? You have to remember that you're always executing it on the hourly time frame. You will not find this pattern every day. If you're waiting for extremely good locations of the pattern, which is what I recommend, this pattern will not occur every trading day. Nonetheless, it has a very high expectancy. Patience is a must for this pattern. So if you have no patience, you probably have no business doing trading to begin with. But anyways, think logically about where traders could be initiated and how you can capitalize on it. And lastly over here, this is an equity curve showing its expectancy, at least from the way that I've traded. I've simulated a 10K account with a 65% win rate, which is what I find this pattern has, with a 1 to 1.5 risk to reward ratio, and on 100 trades with a 20 different equity curves that you can see over here. You would have a max consecutive losers of 7 trades. So be prepared that you can take 7 trades, 7 losing trades in a row before you see this pattern win. and that wouldn't be out of the ordinary based on statistics. Max consecutive winners are 13. And yeah, the average performance over 100 trades with a 1% risk would be 75%. And minimum equity your trading account will undergo would be 9.6k, max equity 22.6. And you can see that even after 100 trades, some equity curves are still underwater, which is to say that you can be in drawdown for a period of time before you see the strategy win, although the majority of them are highly profitable. Because once again, this black line represents the break-even point, and anything under that is drawdown, and anything above it is profit. So be prepared to take losses, because they will happen, regardless of how you're trying to frame it and how other educators may portray it to you. And that's all. And that's it all, folks. Thanks for listening. You can follow my Twitter at IPDATrader if you enjoyed it. Make sure you tune in for the live stream that will begin Tuesday, 8th of August, 8 a.m. Eastern. So hopefully this was helpful, and I talk to you guys in future videos. Feel free to drop a like and a comment with video suggestions. I always go through them. And if you made it this far, thank you for listening, and I talk to you guys very soon. Take care, everybody.